Origins and Promise Picture. A resourceful innovator in 1924, trading kitchen tools for financial ingenuity to birth the mutual fund, a distinctly American creation. These investment bundles offer affordability, simplicity, and diversity, guided by expert hands and bound by strict regulations. By opening the gates to wealth building, mutual funds have welcomed roughly 60 million U.S. households, and many more worldwide, into a broader arena of prosperity, marking a significant stride toward financial opportunity for all. Yet, perfection eludes them. Their near-ideal design carries flaws that shift the game. Most trail the market's pace, burden investors with steep fees, spark tax complexities, and sway unpredictably. Success demands careful selection. Choosing poorly risks a harvest of disappointment. Pitfalls of performance. The allure of recent winners draws many, fueled by a natural tendency to see past success as a sign of more to come. Everyday examples abound. A baker's flawless cakes, a pitcher's unbroken streak, or a mechanic's knack for reviving engines suggest talent and effort endure. So, when a fund outpaces its peers, the instinct is to bet on its continued rise. In finance, however, luck often overshadows skill. A manager riding a fortunate wave can appear brilliant until the tide turns and their edge fades. Funds that soared on the tech boom of 1999 crumbled by 2002, their gains vanishing swiftly. Chasing yesterday's stars proves unreliable. Research, spanning decades, reveals consistent patterns. Most funds fail to pick stocks deftly enough to cover their costs. Higher fees erode returns. Frequent trading tends to diminish gains. Why do top performers rarely hold their crown? Success breeds challenges. Shifting leadership. A winning manager may leap to a rival venture, leaving their original fund adrift. Swelling size. Stellar returns attract floods of cash, forcing choices that blunt sharpness, hoarding safe bets, overpaying for holdings, or stretching thin across new terrain. Fading edge. Early risk-taking or fee waivers boost small-scale wins, but scale and scrutiny dull the spark. Rising costs. Bulk trading and overhead eat more as funds grow, with expenses like 3%, annually setting a bar the market rarely clears. Crowded plays. Triumph tempts managers to follow the herd, clustering around familiar giants and losing the boldness that once set them apart. These traps explain why most funds falter over time. Data from 2002 shows only a shrinking fraction, 15% after 20 years, outpace a basic index fund. Strategies for success. How can the game be played wisely? The index fund stands out, a steady workhorse carrying the full market's weight with minimal fuss. Its low costs, often 0.3% annually, provide an advantage few can rival. At a market growth of 7% yearly, an index fund delivers 6.6%, growing $10,000 to $35,000 in 2 decades, while the average fund, dragged to 3.4% by fees, yields just $19,000. This quiet strength earns praise as a reliable choice for the pragmatic. Not all funds fade, though. A rare few beat the odds with distinct traits. Aligned interests. Managers who invest their own wealth alongside others stay focused, avoiding reckless drifts. Low costs. Funds with lean fees consistently prove that sparing expenses preserves gains. Independent paths. Bold leaders sidestep crowded trends, seizing opportunities others overlook, like railroads in lean years or biotech before its boom. Controlled growth. The sharpest funds limit new investors, dodging the bloat that sinks returns. Understated confidence. Standouts rely on results, not fanfare, letting performance speak. The long game. When should a fund be abandoned? Short-term stumbles, lagging for a year or two, don't justify a hasty exit. A fund might trail the market 40% of its first 30 years yet turn $10,000 into $130,000 by 2000. Temporary dips often pass. Warning signs matter more. Drastic shifts in direction, spiking fees, mounting tax burdens, or erratic swings signal it's time to move on. The urge to outguess the market runs deep. Surveys show widespread confidence in beating the odds, though few track their true results accurately. Optimism inspires, but realism prevails. Guidance from an advisor can anchor decisions, offering not just strategy, but discipline to temper impulses. In this arena, patience isn't merely wise, it's the strongest tool for triumph.